that's designed to focus on the OptionVue software, how to help you use it better. We've been doing it with our product consultants, rotating through, doing different areas of the program. So hopefully everyone is finding it useful. And I'll put this disclaimer up, even though this is about using the software, but these are all educational. We're not making any suggestions to invest or trade a certain thing. And of course, the standard disclaimer about options involve risk, as really does any trade. And let me just put up a little thing of me so you can kind of see what I look like. I've been here at OptionVue Systems since 1999. Hopefully my voice holds out since I'm just getting over a cold and you can hear me okay. So I've been working here with OptionVue for going on 14 years. That's pretty long. I know the software very well. Worked on developing many of the features along with Len Yates here. Prior to that, I spent most of my time in banking, corporate banking, and in Securities and Commodities Division, working with a lot of the broker-dealers, the traders at the exchanges here in Chicago. And I actually first started out after high school going into the Marine Corps, where I was in computer operations, and pretty much since then, after getting my degree in economics, I've been kind of combining finance and computers ever since. So this is what I'm going to speak about today. It is volatility in OptionVue 7. And volatility, of course, is a very important thing in terms of options. Now, because of that, it's throughout the program. And a lot of the questions that I get that get referred to me, some of the more complex questions, revolve around volatility. Things like, in this area of the program, how is the volatility calculated? How are you measuring it here? Or what kind of volatility are you referring to? Should I be using SV or IV or what? So I'm kind of going to go through these things. It's a lot to go through in an hour, so it's just going to be an overview. Some files and preference and program settings you can do. Of course, the Volti charts, which are the basis for giving you a good idea for any asset, what is maybe a normal level of volatility. The survey feature, which is designed to find volatility characteristics, stocks or futures or any asset based on certain volatility characteristics. In the matrix, both where it's displayed within the matrix, what it means, and also in the models, and then how it's used in the graphic analysis. And the last one I threw on, because it does use volatility as an input, is the probability calculator. So mostly I'm going to be in OptionVue, but I made up a few slides that will be helpful, I think. And so the first thing I just want to go over is a very brief definition of volatility and the two main types of volatility. The first one up here, statistical volatility. That's actually measuring how much does the price of an asset actually move or has moved. So that is used for doing certain things throughout the program, things where it doesn't matter what the market thinks. It is simply statistically how likely is this asset to move in price. And the other one is implied volatility. Implied volatility is computed by taking the actual market price of the option and using the option price model to kind of go backwards to figure out what is the volatility that would be needed to get to that price. So there's a number of inputs that go into the option pricing model, the main ones being the price of the underlying, of course, and volatility. But in this case, what you really want to get the correct answer of what an option's worth is the future volatility. What will the future volatility be? That you don't know. And so that's where we're trying to get our best guess of what future volatility will be. And of course, the other things going into it are time, how much time's left in the option, things like interest rates and dividends. So as I mentioned in this next line, forecasting the future volatility is the key to options modeling. So that's why market implied volatility might be a better indication of future volatility than the past measured statistical, because it's taking the entire market, all the people that have actually traded or bidding on that, a bid and ask on that option, taking what they think volatility will be in the future. That is built into the price that they're bidding. Now they might be wrong, of course, but overall, the overall market is usually a good indication of where it is likely to go. So let's see. So let me switch over to sharing my desktop and open OptionVue. And I'm going to start out right at where many people who first start with the program should just first look under File in the main menu. The first choice is Preferences. Here are a number of program settings that are used throughout the program. None of these are really critical in terms of how things are modeled through the program. But since we're talking about volatility, I just thought I'd point out the ones that do touch on volatility. And one of them is down in the middle of the thing here, this matrix shading on by default. And also the next one at the top on the right, daily multi-lines on by default. Now these are settings that you can set here. The matrix shading is in the matrix itself. We'll look at that. And the daily multi-lines refer to if you always want them to be shown superimposed in a price chart. Now these can also be set directly from the matrix or the multi-chart itself. And then in, let me see, oh here, when converting a trade, automatically enter current IV as a note in your key log. So when you hit a convert trade to put something in your transaction log, if you have this checked, it will automatically, in the notes field, put in what the current IV of that option is. And then looking at the other tabs in the colors, you can change the colors of the shading, which show 1 and 2 standard deviations in the matrix, which again we'll look at a little later. And just to give an idea, in the transaction log, as I look at it, the last column is notes. You can type whatever notes you want on a trade, but when you have that one checked, it would automatically put the IV at the time you converted the trade. So now let's go right into the Volti-chart. The price chart and Volti-chart actually use the same form. When you open using the Volti-chart button, it actually opens into a weekly chart. So I happen to select DVY, which is the Dow Dividend Index. It's an ETF of pretty much medium cap stocks that pay high dividends. And you can kind of see the two levels of the blue line is the implied volatility, which is shown down here in the legend. The red line is statistical. So as we had mentioned when we were talking at the beginning, the red line is statistical volatility, is showing how much the underlying price of DVY actually moved. The blue line is telling you what the average implied volatility was at those times. I'm going to change it to being a daily chart by clicking this D up here. So now I can see a more recent history of the last roughly a year, year and a half. And you can see that the blue and the red should track each other fairly closely. Now, many times you can see things like this, long periods where the implied volatility is much higher than the statistical volatility. If you have a market where that's always the case, that's what they would call like a chronically overvalued market, meaning the options are actually pretty expensive relative to how much it really moves. In this case, it looks like many of the times for long sections through here, and recently in the last couple months, there's been a pretty wide gap. Now, you can look at the individual lines, but if you click into the chart, you will get a wand, which you can move around with arrow keys or just drag it around. And that's going to give you an actual reading down at the bottom. For the date, we're looking at 2/28, and it's going to give you SV and IV. And the SV reading is 10.2%. And then in parentheses, it has a 23. And that 23 is a percentile. It's saying 23% of the time, relative to this history that I have, the SV reading was higher than it is today. And the IV shows a current reading of 11.3% with 12 percentile. The 12 percentile is telling you basically 88% of the time it's been higher than it is today. Only 12% of the time it's been lower. So it's near its lowest IV. That's also shown up at the chart for the current. Shows the symbol DVO stands for dollar volume options traded, and that's in thousands. So it's saying on average it trades $45,000 in options a day. And then it shows this SV percentile, 23 and 12. So if I change the reading to different day, of course down in the bottom, it's showing the reading and the percentile of that day for both SV and IV. But of course up here in the header, this doesn't change. The header information is based on today's reading. So of course, this is where you would get your idea. Where is volatility going, or what should it be? What's a more normal? So for example, if you're looking at it right now, and you could just look at a general level, and you're looking somewhere along this line about 10%. Doesn't seem to go much below 10%, the implied volatility anyway. And while it does spike up, and way back here it spiked up quite a bit, ignoring most of the spikes, you can kind of see a general level where somewhere about between 10 and 14% encompasses most of the readings. So you can just see that right when you were looking at it on a day like this, and you saw that the implied volatility was at like 16.9, you're thinking, well, that's kind of high. The options are really expensive. That's the kind of time when you want to be careful about buying them, because when volatility drops back to more normal levels, and you're long that option, whether it's a call or put, you're going to lose money. Or you could look at thinking, oh, they're very expensive now, I should try to sell some. Maybe do a call credit spread or put credit spread. Now also, besides just eyeballing the lines, down in the bottom left there is a little V button, and that gives you a table that shows some averages over the last 3, 6, 10 weeks, 1.5 years, 3 years, 4.5 years, 6 years. So that kind of gives you a little better idea to look at too. And I can bring in the price chart, and then you can superimpose them. If I close this and actually just open the price chart, you'll see it only opens the price chart. But if I superimpose these VOLTI lines on here, and I close it, I've actually changed the setting. If I go look at something else, you'll notice that it has the lines. I can browse to the previous one, like the SPY. Notice it keeps these lines on here. This goes back to where I showed you under File Preferences of having the Volti lines superimposed. And here you can change that setting just by doing it. So you need to turn these off if you don't want to see them. Now, one key thing about the volatility charts is finding potential trading opportunities by looking at maybe unusual situations in volatility. And that is exactly what the survey feature is for. So I'm going to go into this survey and just go over this a little bit. In the survey, you tell it what you're looking for, how many assets to pick. So right now I have it set for 250. Then you choose how do you pick them. And from this drop-down menu, you'll see there's a number of volatility characteristics. The first one, though, is greatest dollar volume options traded. So if you just want to pick the 250 most traded things, highest dollar volume of options traded, and then sort them based on volatility characteristics, you can do that. But you can also pick them based on just looking for simply out of, say, all assets, what has the highest implied volatility, the lowest implied volatility, highest SV, the lowest SV. And then you can look at some ratios, the highest IV-SV ratio or the lowest IV-SV ratio. So if you think about it, implied volatility, the highest IV-SV ratio means implied volatility is much higher than SV, or what would be considered the options are very expensive relative to how much it actually moves. And then the lowest IV to SV ratio, the opposite, the options are really cheap relative to how much it moves. And then the last ones are showing the highest and lowest current IV and SV percentile. So here's where you want to look for something maybe that in the lowest current IV percentile, the options are really cheap relative to what they've been in the past. Highest current IV percentile would be the options are very expensive relative to what they've been in the past. So in that way, the IV tells you something about the pricing of options. The last two don't. Highest current SV and highest current or lowest current SV is simply telling you the price has moved around a lot lately compared, of the underlying, has moved around a lot lately compared to what it's done in the past, or it's been very quiet and not moved as much as it usually does. But it tells you nothing about the options themselves. Let's just choose one. I'll choose looking for, how about the highest current IV percentile, so the options are very expensive. Then you would choose to sort them based on any of those same, including I could just pick and sort them based on this, or I could choose to sort the resulting 250 things by something else. Whichever I choose, it doesn't affect the 250 things. The same 250 things are going to be picked no matter what. All I'm choosing now is how is that list sorted. And in this case, why don't I try doing the highest SV ratio? So the options, implied volatility is the highest it's been. And also, it's extremely high relative to how much the underlying is actually moving. I think I'll just run it only on stocks in the US. And then over here, there's a few other things. You can choose a minimum DVO. Like let's say I don't want to trade anything that doesn't at least trade $40,000 in options a day. This is in thousands, so I'd put 40, meaning it trades at least 40,000 a day. A minimum price, I don't really care about a minimum price of a stock, but some people might not want. I can put something in. I don't want a stock under $5. And a minimum history to use, meaning if it's relatively new, maybe it just had the IPO 3 months ago. This is in 0.2 years is the smallest that you can put. And I'll just keep it at 0.2, the lowest. So even relatively new things will come up. And then percentile uses, I'll say since I'm using highest current percentile, how about over the last 3 years? And you can choose to run it on your NetView database or local files. You almost always want to keep the default setting in NetView database. Your local files are not going to be as big, and it's really designed for people who are maybe created some asset files for foreign markets that we don't have in our database to run it on that. And you can see once it goes out to the server and gets it, and then it comes up with the list. And here's what came up at the top. Just select it so it's highlighted, and then hit the Volatility so I can see the Volatility. I'll kind of restore down this window so you can kind of see the list behind it. And you can see that recently there was it's been uptrending in IV, basically up to about 100%. From where it was down at 50 over here, and there's a big gap, which is how we're sorting it between IV and SV. Now, nice thing about any list in OptionVue, once you have a window open, whether it's a matrix, price chart, or Volatility, you can use this browse button. So I can click next here, and it's going to go to the next one in the list. You'll notice the second one down is highlighted now. So again, you see this big gap between IV and SV and a big uptick. I'll just kind of page through them so you can kind of get an idea of what it's found. So let me close this. So that's a survey. But now I want to go to the matrix. The matrix is where you're looking at the whole option chain. First, I'll just kind of show you my matrix. Actually, I just have this set to the default that gives you a lot of months, only 3 columns, and for those who aren't sure, this legend is either on or off, and that shows you what each column represents. So I have market price, MIV, which is midpoint implied volatility, and then trade. But you can set up the 3 different default formats using this format button, and right between legend and format are these little 1, 2, 3 buttons, and I do have other formats set up. So let me click on the 2. This is my format 2, and looking at the legend, I'm actually looking at the last, bid, ask, projected volatility, and trade. So this is kind of good just for looking at markets when you're actually interested in trading something, I think, because you can see the actual last traded price. You'll notice the R's, meaning this option hasn't traded today. So only these 2 traded in these calls in March. And then the bid and ask price. Now the projected volatility, similar to the MIV. So notice this at the money March is 10.1. Let me go back to my first one. And notice the MIV is 10.4. And you might wonder why I even show that projected volatility rather than MIV. And it's because, first of all, you'll notice that there are large number of options that have no MIV shown. So, and especially in the nearer term ones with very little time left, notice how there's no MIV on these 4 calls, and these 2, and these puts, Only 2 of the puts actually have an MIV calculated. Well, MIV is only calculated in certain situations. So for example, looking at these, they're basically worthless. No one's willing to buy them, but people are putting out bid prices, meaning you get the ask of a nickel. You can go out and buy them for a nickel. But this price is really not telling you anything useful about the option because they're all a nickel. Now let me go back to my format 2. You can see there is no bid, but here's ask 15, 15, 5, 10. Those prices are really just garbage. I mean, if you really wanted to buy a far out of the money option, you could maybe come to this one for 10 cents or even 5 cents here. But there's no way you'd ever buy this for 15 cents when you could buy this one $1 closer to money for only a nickel. So calculating MIV for these really means nothing. But you'll notice the projected volatility is filled in fully. And there's a reason for that. The MIV, the midpoint implied volatility, is being calculated on the individual price of that one option. But the projected volatility is showing you the volatility skew. It's taking all the MIVs and we're drawing a best fit line, and projected volatility tells you where does this option fall on the best fit volatility skew line. So you always will see a projected volatility for every option. No matter how far out or deep in the money, it will always be there. And let's just look at this last format I have, which I just set up today just to kind of show anything related to volatility in the matrix, in the parameters. Of course, first I have prices, the market price and a bid-ask price. There's MIV, which we showed initially, and it's a nice thing to show. But connected with this bid price is a bid IV. So it's calculating the implied volatility option based on the bid price. Here's the ask price, and then there's an ask IV. So it's calculating the implied volatility based on the ask price. And as you might guess, the MIV is pretty much right somewhere in the middle between the bid and ask. And then there is this projected volatility, which we just talked about. But we're going to go into much further. I'm going to go into the modeling and show the volatility skews. So I'll show more on that. I also showed Vega. Vega is one of the Greeks along with delta, gamma, theta, and rho. Vega measures its sensitivity to changes in volatility. And the volatility, meaning 1 point, maybe from, in this case, around 13.6, if implied volatility rose to 14.6, everything else staying equal, same day, no change in underlying price, you would make $17.60 if you're long this option, or lose it if you're short. And the last thing I have here is just the theoretical price, because theoretical price is the fair value, and that fair value is being calculated based on the underlying price, time left in the option, dividends, and this projected volatility. That's what's used in calculating a fair value or the theoretical price. The volatility from the projected volatility of the volatility skew, not from MIV. So let me just break for a second and go back to my presentation, because I created this slide because it's a common question about why doesn't every option have an MIV displayed in the matrix. So here is the actual rules, which I just copied from our help file. Implied volatility is computed from all options which meet the following criteria, meaning it has to meet all of them. First, you need a representative market price for the option. The strike price is within 80% of the price of the underlying. The option has to have at least 2 or more remaining days of life. It has to have at least 15 cents worth of time premium. And then the last one is that the option must have an in-the-money factor greater than minus 0.275. Now that last one is kind of technical, so I kind of put the definition here that the in-the-money factor is the natural log of K over S divided by the square root of time, where S is the price of the underlying asset and K is the strike price. So that's pretty complicated, but it's basically just measuring how in or out of the money is. And by bringing in time, hopefully this makes some sense, it's telling you that a 5-point in-the-money option with 1 day of life remaining is considered deeper in the money than that same strike with 30 days of life remaining. While I'm in here, I will go back and just see if I have any questions here that as I'm going through real fast. I see will survey find 250 underlines or individual options? Oh, hopefully you saw that from when I ran it. But all that shows up on the survey are a list of stocks or futures or the actual markets, not individual options. I see someone's asked me to do something in the survey, but I'm not really doing a survey here, and I still have a lot to go through because I'm just in the matrix getting ready to go into the models, which is the volatility modeling in OptionVue is really the heart of the program. And everything is based on it, including your projections, your profit loss in the future, your graphs. So I really want to get into that and the thing, and it's going to use all my time today. And hopefully that's more what people are interested in. We've actually done OptionVue Essentials that the recordings are available, I believe, that have all on things like the survey. I wanted to mention in here that there is this S button in the matrix. And this S is for shading. What it does is that, let me go to a better format. You can see right here is the at-the-money strike, 61 call, and the 61 put. It's trading at 61.09. And you have this pink shading. This pink shading is 1 standard deviation. The blue shading is 2 standard deviations. So if you're going to look at maybe selling something 51 days out, and you want to go out at least 1 standard deviation, you would have to at least sell this one to be outside 1 standard deviation. This one to be outside 2 standard deviations. This isn't exactly the best asset to be looking at to give good ideas of what to sell, because no one would go out and sell this for a nickel here. It wouldn't even be possible because there's no bid price. But I did want to mention that there is a box here that's the Volti, and it's got 10.2 in it. And so now I'm going into the model. And when you go into the model here, the model of an asset, there is a button right up here in the upper left called Volatility. This is going to give you all of the volatility models right here. 2 tabs, Measurements and Settings. The first tab here, Measurements, this whole upper section is about the variable volatility model. So the top half is all on that. It shows the breakdown and a grid here of the calls, puts in both, and what the average is overall for all months, and then individually for March, April, June, September, which are the 4 months I have in the matrix. And so on average, these March calls are 10%. June's are 10.5. These September puts are 9.4. Now here you can use the combined call put skews. And you'll notice when I check this, this line goes around showing this is the volatility skew being used. And if I choose one, like let's look at the Junes, and I click on the skew graph button, it is showing you the each day, 3 days. This one is today, the solid line. This dashed line was yesterday. This is the day before. What the measured volatility skew is. And it's showing the calls of it's where the individual ones are falling. And you'll notice that it's the June volatility, so it's volatility on this axis, versus this in the money factor that I showed you before. There is another way to see this that we have in the pro version, in the manual skew. I can go into the manual skew, and maybe this will make it a little easier for you to see. I'll make it as big as I can here. And you have some buttons here. First, I'll set to implied. Here's the various strike prices of the stock, 53, 54, 55, 56. And you can see the actual dots. This is the measured implied volatility, the MIV of every one. Now, this is not what's being used in the program. You can see it can be quite jagged in places. Should this really be lower than this one? Probably not. Now I'm going to click to set the variable. Now you can see what the program's actually using. It is drawing the best fit volatility skew curve through all the possible points. And notice it's a nice even line, and behind it you can see this jagged measured one. So if you simply used what it was in the measured MIV, that's what you would be using. But it's this line that we're drawing, the best fit curve, that's being used in the program to calculate things like the fair value. So for this option, it's not using this measured right here. It is using here, where the little dot is. So hopefully that's a little easier to see. So behind each of these, there is a skew graph, the skew parameters, which would show you basically the coefficients that are used in the curve. You know, every quadratic equation describes a curve, and this would be like the ABC there. And a skew override, which just shows you what some of the measures are at each strike, calls, and puts. So this is the variable volatility model. That is what it defaults to using in OptionVue, as long as there's at least 3 strikes with good data and readings. There's also down here the uniform volatility models. Uniform volatility would mean every option has the same implied volatility, and that would be basically a horizontal line at whatever one you chose. In this case, the grand average IV is 11.4. You could simply use that for every option. Just say, the MIV, no matter what the option price is, the MIV is 11.4. Or you could use statistical volatility, and here the measured is 10.2. You can actually go back in and see things like the days accumulated and what it's using to calculate this average. And it's weighting it by day. And same thing on SV. The SV is simply a list of all the highs and lows of the day for the last 20 days. It'll pull this right in from the price chart so that it's complete as soon as you begin using OptionVue. But you'll notice that's 10.2. That is what it brought in here. That 10.2 is what is being used to calculate the shading. You could choose a different number, like maybe just say, I'm interested in September and I want to use this at the money call IV of 11.9. You could just type it in and it would change. That wasn't a big enough change to make really any difference, but it will. Now, I guess what this is really doing is creating this log-normal distribution. And I think the easiest way to show that is let's look at a trade and look at the graphic analysis with volatility. I'm going to just sell this and buy 10 of these and just make a simple calendar spread. Hit Analyze. And you can see that if I choose today, here's that expiration. Maybe I'll just go look at expiration here. Notice down at the bottom are two bars. They're fuchsia and aqua, which are the same shadings in the matrix. And it's showing 1 and 2 standard deviations. So it's basically creating a log normal distribution centered around the current price. You'll notice this one's kind of skewed to the left. That happens more often on stocks that pay relatively high dividends like this ETF does. And when I just hover my cursor over these bars, you'll notice in the center right here it shows V equals 11.9. So it's actually using that input that I put in of 11.9. And then it's showing you one standard deviation. The actual number is 57.89 and 63.33. And the actual endpoints of two standard deviations is 55.35 and 63.33. Or I'm sorry, 66.23. Now in the graphic analysis, there is a place where it asks for a voltage change. And it's here, and this is in points. And when you're looking at a voltage chart of this asset, and you're looking at where it is currently, and you say, actually, I think that the overall level of volatility, this is not based on because of a change of price, but just basically market sentiment is going to drop. And IV is going to go down maybe 1%. I can put that in there, a -1, which is basically telling it from like 11 to 10%. And you'll see that this immediately dropped, especially the zero line, but the whole graph became less profitable. If I go back to zero, you'll see where it is. Actually, you can see it's hitting about a high here of around just a little over $500, about $550. If I think volatility is going to go up 1%, this is implied volatility. That's the key thing to mention. Implied volatility change, meaning the implied volatility of all the options is going to rise. If I go 1, you'll see now the maximum profit is almost up to $700. So that made a big difference, just a 1% change in the overall level of volatility. Now there are other models, as I mentioned. Right now I have it set to manual. Let me go back to the variable and hit Analyze. Make sure I'm doing this right. and have all my settings correct. Okay. So with variable, it's analyzing it that way. Now we'll choose a different one like uniform. And if I actually went back to the model to just make sure, and uniform in the settings, you could use all grand average IV, all statistical, and I'm just going to keep it at grand average. Or I could do like 50-50. But I'm just going to keep it all uniform. The first thing I'll mention is if you look at this projected volatility in the matrix again, notice every option has the same projected volatility, 11.4. When I hit analyze, it's going to use 11.4 and assume everything always stays at 11.4. Now, there is one other model, and let me look at the MIV here, that uses these measured MIVs, and it's called the EIO-IO model, which stands for every individual option is own volatility. It means that whatever this reading of MIV is, that's what we're using, and that's what it will stay at forever. And it's not very useful for trading, but it gives you better looking graphs that the T+0 line always goes through the fair value. So let me go and look at the slides, because when we're doing this analysis, let me just change it back to all the correct things. Variable, using 1 day, you can use more than 1 day. And then there's, in the settings, the CEV factor. The CEV factor is calculated, called constant elasticity of volatility. And what it does is, it's measuring in the past when the price of the underlying changes, how much has the entire volatility skew shifted up or down, meaning every option's IV went up or every option's IV went down. And so I made some slides to try to make it easier to understand that. Let me just look at one option, like I buy some options. When I'm looking in this graph, and I'm looking ahead in time, in this case, I just selected the 103 days out, and I'm saying, well, the stock is at 63. I'll basically make $980. I can actually click on this details button here, put the price in, 63, no change in volatility levels, and it's going to tell me right now I can buy it for $1.67. At this date in the future, at this price, it's going to be worth $2.60. That's how it calculates that I'll make a gain of $930. The key thing is, when constructing this graph, how does it come up with this theoretical price? It, of course, uses the options pricing model, and it's using this date, so it knows how much time's left in the option. It's using this underlying price. It's assuming all the same dividends through here and everything. The only key thing is, what volatility is it using to calculate this fair value? And here's where I made a couple slides. Hopefully will make it a little clearer to you. So let's say just looking at a graph and the stock drops $1. What I did was I drew the volatility skew. And you have an at the money option right here, ATM, at the money. And the current MIV is 11.4%. Then the stock drops $1. So now, what should I use as the MIV to calculate the fair value after the underlying's dropped $1? keep using that 11.4? Well, what OptionVue is doing is saying this option is now $1 out of the money. And so here's one that was $1 out of the money. It was at 10.4. It's going to go along the skew curve and say the implied volatility of this option dropped 1%. 1 point. So from 11.4 to 10.4. So that's what OptionVue is going to use to calculate the fair value at this new price. Not keep assuming that the volatility of the option will remain the same, because of course it won't. Then we have that CEV factor, the constant elasticity of volatility. That's the entire volatility skew shift. So here's this one above is right here. The at the money is 11.4. Now, because this is kind of what do you call it? A spectacular move for only a $1 drop in the stock, but he did it just for demonstration purposes, of course. The entire curve shifts up. That's why I have all these little arrows. And so now the at the money went from 11.4 to 11.9, a 0.5% increase. So as the stock price dropped, the entire IV curve shifted up. And that's that number, the CEV factor number, that's measuring really how much of a shift is there. It's of course not as dramatic as this. I just did it, as I also put on this next slide, that this total effect of $1 drop in stock price, for demonstration purposes only, this is not to scale or a real world example, just that as the stock drops $1 and the vol skew curve shifts up, what's happening to the option that you own, it was an MIV of 11.4, went up by 0.5% because of the CEV effect, but it's now $1 out of the money, so the new MIV is actually 11.9. So hopefully that's where it will move to. Not simply along the curve, not just the curve shifted, but both. So let me go back to OptionVue here. So when I'm in here looking at this, and it's calculating all these various option prices at all these different times and everything, all along those curves, it's taking into account all those effects. So now, if you're thinking something like, well, I think that the stock's going to drop quite a bit, like $3. And I've noticed in the past that when the stock drops that fast, the implied volatility shoots up. That kind of a move is already taken care of by OptionVue based on past moves. So in this box, the only thing you'd want to put is things that have changed, just thinking more along the lines of people are going to think maybe it's a bank stock, and I think bank stocks are going to fall out of favor. The implied volatility of all the options are going to go up a lot because the entire sentiment of the market's going to change. So it's not representing what's happened in the past based on price moves. This is an entire sentiment shift that I'm kind of projecting here. Let's see, I know I'm getting close here, but I think I've hit most of the main ones. One last thing I will look at is in this graphic analysis, I just want to point out that you can step through the volatilities. And in that case, I think I'm going to just go back to using a calendar spread. And, well, zoom in. And over up here is It says step-through dates is the default at all times. So each line represents a different day and time. 6 days from now, or 8 days from now, 16 days from now. But you can also step through volatilities. And when you choose that, then this volatility change box becomes volatility change per step. And I'm going to put in 0.5%. Go up to 5 lines. And you have to choose a specific projected date. Let's say I want to know a week from today, 7 days from today, March 7th, if volatility moves up. Right here, this solid line, looking at the legend, it says V plus 0. So that's with no change in volatility. In 7 days, if volatility doesn't change, that's what the profit loss of this trade will look like. But if volatility goes up 0.5%, 1%, 1.5%, 2%, so you can see, even with the price ending up the same, or around 61, I'd make $260 versus $60, a big difference on a $690 trade. Now I can also do the opposite. What if it goes down 0.5% a step? Here's how my trade looks like now, but if implied volatility drops 0.5%, 1%, 1.5%, 2%, you can see I can't win. The best I can do is lose like 150 bucks or 140 bucks. That's the best I can do. So you can see how important the implied volatility can be to a trade, especially something like a calendar spread like this. And I promised that I would also look at the probability calculator, but I'm only going to glance at it because in the probability calculator, it'll calculate the distributions, the 1, 2, 3 standard deviations, and you can put whatever you want in here, but if you have a stock open, or any asset open, of course, and you open the probability calculator, it'll automatically put in this current price and the future statistical volatility. And you'll notice it has that same 10.2 we saw, which is in the shading. That's pulling from that uniform model, the statistical volatility. And now it can go so many days ahead, 7 days ahead. So that's where this input comes from. And it's really designed to create a bell curve, and here's the bell curve. It's showing the readouts from it. 1, 2, and 3 standard deviations down, 1, 2, and 3 standard deviations up. And so again, in this model, in the matrix, volatility, it's pulling this statistical volatility. Let me go back to my charts here. I knew this would be tight to get this much stuff, even as an overview, into an hour, but it has been exactly an hour, so hopefully that's not too long for everyone. Let me just go back and look and see what kind of, if I have any questions or anything. How do you choose the days accumulated? I see some people were answering for me too, but that's the days accumulated in the uniform models. Those just come right in, like the SV comes from the price chart, the high and low. Can you get an accurate graph presentation when you mix weeklies and monthlies with large IV differences? For Lewis Tomsic. And the answer is yes, it will be accurate. What happens, though, that's assuming the graph is accurate, assuming that differential remains in place. So I think your question is really, can you project a big change in just one of the months and not the other month? Assuming, meaning you're assuming that they're going to go back together. OptionVue is going to assume that the differentials between the months will persist. There are, of course, ways, especially Steve Lentz talks about a lot in his market huddles, where he's talking about his earning calendars and things. If you haven't been on any of his market huddles, just give your product rep a call, and he'll set you up to at least see it. I see someone was confused with my one graph about the stock going down $1. And let me go back to my graph a second. I know it was pretty primitive. I just threw it together. But I'm just saying the stock drops $1. The reason this looks like it's maybe going up, it's that this is the vol skew curve. This is the at the money option. This is one that's $1 out of the money. And I'm saying that when the stock drops $1, this at the money will now be $1 out of the money. So that's why this MIV will change to being the same as the $1 out of the money is now. Hope that makes sense. And someone just asked me what's the most accurate volatility model, and definitely our default, the variable volatility model, is the most accurate. When as long as there's enough data too, which is the majority of stocks and ETFs, I would also suggest there's plenty of data. You don't even need to combine the call and put skews. I would make that your default of not combining them. And so many of the electronic markets now, there's plenty of bid and ask, even if it's not trading, that it allows you to change to using an average of 1, 2, or 3 days. But 1 day works for almost all stocks nowadays. Uniform would always be the worst, of course. It would just never be right. It would not model real world. And as I mentioned at the beginning, yes, I've definitely recorded this, so it will be posted. We always post it right away to our Facebook page, which is actually, I don't know if it shows up on here, but our OptionVue systems page. I might need to make sure I'm sharing my desktop. And then it's just Facebook OptionVue Systems. You don't even have to be a Facebook member to come in and look at it. And we post everything out here. Like here's a recent blog entry from Steve Papelli on the basics, the row Greek. Posted, actually I talked about the Traders Market Huddle that Steve does every week, where he does a lot of modeling of calendar spreads and how to do that in earnings plays. I actually have the recording from this week's out here, so you could go see the recording from it. And just looking through other recordings, like here's last week's OptionVue recording. Here's risk reversals that Steve Papelli did, which is about synthetics and things. So we put a lot out on this Facebook page. Let me go back to my presentation. Yeah, and at James OptionVue, James usually puts it out on YouTube also. I see. I know what Dan's talking about, and I've talked about it after you mentioned it, about indicating what's the best IV or SV number to be using in OptionVue. If I go back to looking at OptionVue, where, for example, I had talked about here in the matrix with the shading, that automatically brings an SV. Actually, this is future volatility. We're using SV as our best guess for creating the log-normal distribution. So it's actually the one problem we have with labeling it SV is that it's not SV, it's future volatility. And also in the graphic analysis, I don't have a trade in here anymore, but when I analyze in here, this volatility change, again, that's future volatility, not really implied volatility, even though you could call it you're projecting a future change in implied volatility. So we've talked about it, but I don't think we've come to a resolution on that one yet. Okay, now I've gone over quite a bit answering these questions. So if you have any questions, as I showed on the presentation, you can always email me, Jim@OptionVue. I'm always around. I see. Oh no, it's so. John asked if it's future vol. Why do you label it SV? We don't label it SV. It's simply labeled VOLT. Someone's asked that we put SV in there, but it's just simply labeled VOLT. But we bring in SV as our best guess for that. All right. Well, thank you all for attending. I hope y'all learned something, and we will post this. So have a good day. Bye-bye.